Good evening. This is Doc Severson for the Theonite Report for Wednesday, September 13th. So here's the level everybody's watching. S&P 2500 is within inches, within the grasp, and the market just could not do anything today. Could not get up there. So it tried. Probably what we're running into is just a little bit of exhaustion and a little bit of overhead supply. Well, maybe a lot of overhead supply as we get near that 2500. Remember, the price is made about an 80-point swing off the bottom here. So we have not only traders taking profits at this level, but also certainly sell orders that the price has to plow through before it's going to overwhelm that supply with more demand. Really, do we want to buy at the highs? This is what we're seeing right now, is that markets are just not after. The only way we're going higher is to go down first. The only way to go higher is to go down first. You got to take one step back, two steps forward, one step back, two steps forward. Is this enough for this particular swing? I'd say in a couple of days, we're going to be sitting at an exhaustion level, much like what we were in mid-July and also late May, early June. Same kind of thing, is that range expansion like this leads to range contraction. This is the way the market's moving right now. It's just grinding up incrementally, and this is why, because we have these concrete overshoes over here on the monthly chart. So for that reason, yesterday I talked about setting up a calendar spread, and if I set it up before Friday, I need to use the SPX because Friday is ex-dividend day, and we're going to see the spiders kind of come down by the price of the dividend, so it messes that up a little bit. But with the SPX, we don't have that issue. The only problem is that, it's a much larger notional value instrument. Many people are more really kind of comfortable setting up trades with the spiders, which are 1/10 the value. So if I get the signal to enter this trade on Friday, I'll be very comfortable to enter it with the spiders because by that point, the dividend has already been taken out to be paid at a later date sometime. Now, a couple of tips on the calendar spread. First of all, I'll go to the option chain here. I usually start with puts because the way that I adjust these trades is when I start with an initial calendar spread like this, if the price goes higher from here, I like to set up then a call calendar spread above the money. So I'm typically just trying to get these things out of the money if at all possible. So if I start with the put calendar spread, get that out of the money. And that's helpful if we use something like the spiders, which is American settled. Not that we're going to be assigned on there, but just that's one less thing to worry about. And so what ends up happening is that we end up creating kind of this circus tent. If we have to double the calendar, if the price moves up, we have a call calendar up here, put calendar down here, everything's out of the money, everything's good. Now, if you might be asking, well, what about a downtrend? Well, typically in a downtrend, I'm not playing this strategy because we have more implied volatility to work with and maybe even vertical spreads would be back in play again. Now, something else that we would watch for this strategy is the volatility differential. So if we look to sell the short-term option here, maybe with something about 20 days or so, we're going to be looking at, let's see, maybe about 7% right now, 7.1%. What we want to make sure is that we're not selling this option and buying too much on the back end. So if we have to go out to maybe say like October, the October monthly, we're paying about a 1% premium on that back month option. So a lot of times you'll hear people say, well, you should be selling way more implied volatility than you're buying. That gives you an edge if you get that volatility differential between the short option and the long option down here. Well, that sounds great in theory, but what that also means is that there is a huge risk event which is being priced into the short-term options if you have a lot more premium there. So you can see, just generally the implied vols here for this cycle in October is about 9.8%, and then the one back here in the back month in October is about almost 11%. So that's okay. That's pretty normal that we're going to have a little bit more volatility creep coming up there and into the back months. So really when it comes to these two options, I want to make sure that this is within 2%. And right now, this is just a little bit over 1%. That's pretty normal. Now, we can get, we do have times when we do have a little bit more implied volatility or they're equal, which is even better. But again, be careful if something looks too good to be true, because it usually is. It's pricing more risk into that front month option. Something else that we've noticed here is that the Russell futures, which used to be called the TF futures, right? So, well, they're now called the RTY, and they're over, instead of being an exchange that will not be named, they are now over at the CME Group. So that's a good thing. We're going to start to see volume increase on the Russell futures again, which is good. So the more liquidity. The other change that you'll notice about the Russell futures is this was always good, is that they had 1/10 granularity between the different price points here on the futures, right? So each one of these is 1/10 away. That's great, but the problem was that these used to be $10 a tick on the old platform, $10 a tick, and that was just kind of a monster contract out there for the Russell futures. Now they are $5 a tick, so for a whole point, it's $50 with some really nice granularity on here. So if the volume can be pumped up a little bit, this is going to be a really nice futures contract to be able to trade. So again, watch that 2500 print on the S&P futures. That's the big battle that's going to be happening between now and the end of the week. We'll see who wins that battle. Thanks for listening to tonight's report. We'll see you tomorrow.